Welcome to The Explainer. Today, we are diving straight into the hidden plumbing of the global economy to ask a truly massive question. Is the international financial system, the one that actually governs the world's most critical commodities, starting to crack? For decades, this system has operated on a very specific set of rules. But right now, those foundations are facing unprecedented pressure.
So let's look at this direct collision. Does the structural power of Western finance still hold the ultimate veto over global energy markets, or is the rapidly expanding BRICS coalition finally breaking that grip through geopolitical fragmentation and these emerging multipolar networks?
To figure that out, we are going to break this down into 5 quick parts. First, the ultimate energy veto. Then, the anatomy of Western power. Third, the BRICS alternative unveiled. Fourth, the limits of the BRICS challenge. And finally, dilution, not displacement. Let's get into it.
Starting right off with Part 1, the ultimate energy veto.
You have to understand, Western dominance isn't just about military might or direct commands. Following scholar Susan Strange's concept of structural power, it's really about holding the invisible financial strings, the actual plumbing of the global economy. Think about it. If you control the banks, the credit lines, and the security rules, you effectively hold a veto over anyone trying to buy or sell energy just to survive. It's a massive amount of leverage.
Moving on to Part 2, let's look at the anatomy of Western power.
This Western structural power essentially operates through a triad, a 3-pronged approach. It starts with petrodollar dominance, where the vast majority of global oil and LNG contracts are priced and settled directly in US dollars. Then you add deep capital to the mix, which funds those multi-billion-dollar energy projects. And finally, you have coercive infrastructure, like the SWIFT messaging system. Because this setup is so entrenched, virtually every energy producer on the planet eventually has to route their money through a US-regulated bank.
Just to show you the sheer depth of this capital reliance, research from Carnegie highlights an absolutely incredible data point. The Abu Dhabi Investment Authority, which is one of the largest sovereign wealth funds in the entire world, holds more than half of its portfolio in United States assets, over 50%. So even as Middle Eastern petrostates look to invest heavily in Asian markets, their economic gravity remains totally anchored in the West.
But what actually happens when that system is used as a weapon? Well, when the West's coercive infrastructure was deployed against Russia with its 2022 SWIFT exclusion, we saw a fascinating macroeconomic stress test in real time. And yeah, export revenues did stay temporarily elevated because global oil prices spiked. But the real story was a steep, lasting contraction of Russia's international reserves due to massive asset freezes. Sure, alternative payment systems can keep some transactions moving, but they severely lack the global reach, the deep liquidity, and the institutional trust of SWIFT.
That brings us to Part 3. The BRICS alternative unveiled. Just look at how rapidly BRICS escalated from a sort of symbolic group to an actual institutional architect directly influencing global oil and gas production. They established the New Development Bank back in 2015. Then, they clearly saw the urgency when Russia was excluded from SWIFT in 2022. By 2024, they expanded their ranks to include massive energy producers like Saudi Arabia and the UAE. And now, they've accelerated their timeline for rolling out alternative payment systems like the BRICS unit and BRICS Pay by 2026. It's moving incredibly fast.
Side by side, you can see BRICS is executing a very deliberate strategy to bypass that Western veto. While the Western paradigm relies heavily on the SWIFT system, dollar settlement, and World Bank conditionality, the BRICS paradigm is countering that. They are linking their own national networks, things like Russia's SPFS, China's CIPS, and India's UPI, into a cohesive, decentralized alternative that literally doesn't even need to touch a Western bank.
As a highly practical example of this shift, the New Development Bank specifically aims to denominate 30% of its financing in the national currencies of member states under its current strategy. And this matters immensely because the stated goal here is prioritizing flexibility and shielding borrowers from external monetary policy shocks or crazy exchange rate mismatches.
We are also seeing the introduction of the pilot BRICS unit. Now, this is a really fascinating alternative settlement instrument because it is meticulously backed by a unique mix, 40% gold and 60% member currencies. It's essentially a very calculated attempt to create a trusted medium of exchange that just isn't vulnerable to Western sanctions or the wild fluctuations of the US dollar.
Of course, backing a brand new system like this requires immense physical assets. And get this, collective BRICS gold reserves are now reported to be well above 6,000 tons. 6,000.
That immense accumulation of physical wealth is literally the bedrock they are using to generate institutional trust in their new settlement instruments.
Now, let's pivot to Part 4, Limits of the BRICS Challenge.
We really can't overstate the ambition here. There's actually no unified consensus within BRICS to just kill the dollar overnight. In fact, if you look at the July 2025 Rio de Janeiro Declaration, they didn't even use the term de-dollarization. Actually, in practice, members remain committed defenders of the IMF and the WTO. They heavily favor a gradual expansion of local currency options rather than just blowing up the incumbent system altogether.
Furthermore, Brookings research points out that this financial fragmentation is highly asymmetrical. So, large, strategically autonomous states like China or Russia, they can afford to build alternatives and absorb the shock. But emerging market economies? That's a totally different story. They remain deeply dependent on Western capital and would face punishingly high borrowing costs if they tried to fully decouple. It's just not feasible for everyone.
And we have to remember, the West's coercive infrastructure isn't just passive, it actively pushes back. For instance, in 2025, the United States explicitly threatened 100% tariffs against BRICS members who were pursuing dollar alternatives. This is a pretty stark reminder that Western leverage can instantly pivot to inflict massive pain on trade relationships, even if the financial initiatives themselves fall short of full de-dollarization.
Which brings us to our final section, Part 5, Dilution, not Displacement.
So what is the final verdict on our core question today? Does Western finance still hold the ultimate veto? Well, Wood Mackenzie and other experts point out that Western architecture absolutely remains the default mechanism governing energy finance. But BRICS has successfully expanded settlement options, especially for intra-block trade. So the big conclusion here is that the Western veto is diluted, but it's definitely not destroyed. We are looking at a global system that is now harder, costlier, and slower for Washington to weaponize, yet one where the dollar-centered order remains firmly intact. And that's simply because no rival can yet bear the full weight of global energy finance, all by themselves.
I want to leave you with this final thought. If network effects are lowering the cost of migrating away from the dollar and financial power is no longer an absolute unquestioned veto, how exactly will the next global energy crisis be priced and settled? Will it be in dollars, gold, or some mix of local currencies? One thing is for sure, the financial and energy dimensions of this contest have become completely inseparable. Thank you so much for joining this explainer. Keep questioning the consensus, and we will see you next time.